Good morning, everyone. Good morning, dear students. How are we all? All good? Yep. Good morning, Vignesh, Kushi, Niranjan. Good morning. Yeah. So, this is the last session of mutual funds. We have started the topic in the previous class, and in the previous class, we have understood how a typical mutual fund is established, who all are the parties involved in the mutual fund, starting with the sponsor, to the AMC, the distributors, the registrar and the transfer agent, then the custodians, right? And after that, we understood what were the various types of mutual fund options that we had. So we can have the classification on the basis of functionality, which can be open-ended or closed-ended. Then on the basis of portfolio, we have seen that it can be debt, equity, or some special funds. Even under equity, we have covered like what are growth funds, what are aggressive funds, what are the income funds, right? Under debt funds also, we may have bond funds of different categories, gilt funds, which are government securities bonds. Then some of the special funds like our index funds, international fund, offshore funds, sector-specific funds, or those funds which target specifically the money market, gold funds, quantitative funds, or capital protection funds. And we also understood what is the concept of capital protection in the last class. Some of the types of schemes that we had like something called as the balance funds, which is equity and debt. Then we had diversified equity schemes, which is a large cap, mid cap, small cap, and multi cap, right? So these are the types of schemes that we have. Then we have simply understood what are the advantages, disadvantages of the mutual funds. Why should we go for mutual fund, and what are the discouraging factors before we make an investment into the mutual funds? We also understood something called as a entry load, exit load, and also something that's the trailing commission, which is paid to the mutual fund agent so that their clients are keeping their investment with the fund. Right? And then we started like a few questions, and we have covered like quite a good number of questions. The previous question that we did was question number 12. Now let's do some more questions and concepts that we can think of from the mutual fund point of view. So let's now get started with this question number 13. Let's get started with this question number 13. So this is done. That is done. Now, question number 13. It's a small question, but requires a good deal of understanding and a good deal of understanding how a mutual fund works, and also some sort of basic common sense. Okay, let's have a look at it, guys. So we have like Mr. X on 1/7/2007. During the initial offer of some mutual fund invested in 10,000 units. So initially, the mutual fund had purchased like 10,000 units, right? So let me just write down the facts over here, so that actually helps us to understand and solve it quickly. Good morning, Ginny. So we purchased like 10,000 units on 1/7/2007. 1/7/2007. Let me write down the few basic components. So we have like 10,000 units. 1/7/2007, we have 10,000 units having a face value during the initial offer. And of course, at that time, the face value or the NAV was 10 rupees. Right? So we can say the investment. What is the amount of investment that we have made on 1st of July 2007? What is the amount?
1 lakh. 1 lakh rupees.
1 lakh. So that's the units multiplied by the NAV, which is simply 1 lakh. Okay. Then let's have a look at the further set of transactions. Then it says that on 31st of March 2008, dividend paid by mutual fund was 10%. Okay, so dividend paid by mutual fund was 10% on 31st of March 2008. So on 31st of March 2008, we had a dividend of 10%. Okay. And then it says that mutual fund found, the Mr. X found that his annualized yield as on that date was 153.33%. Okay, so after the payment of this dividend, the question says that there has been an annualized yield of 153.33%. Okay, so considering the amount of dividend, let me take it as 10%. Okay. Considering the amount of dividend, we say that as on this date, which is 31st of March, the annualized yield stands as 153.33%. Okay. On 31st March 2009, and again on 31st March 2009, a year later, 20% dividend was given. Okay. So on 31st of March 2009, March 2009, 20% dividend was given. And at that time, the annualized yield as of 31st March 2009, 20% dividend was given. And on this date, there is no information about, again, the annualized yield. So neither do we have any information about the NAV also, as on these dates. Then on 31st March 2009, 20% dividend was given, that's recorded. Then on 31st March 2010, Mr. X redeemed all his 11,296.11 units. So 31st of March 2010, 31st March 2010, Mr. X redeemed all his balance of 11,296.11 units. So you can see the units as on 31st March 2010 was 11,296.11 units, when his annualized yield was 73.52. So at that date, its annualized yield was 73.52%. What are the NAVs as on 31st of March 2008, 9, and 10? So this is what we want to calculate. As on these dates, what are the NAVs of the question? Right? What are the NAVs of the mutual fund? You can see I've taken all the information in one table. So initially 10,000 units with a face value of 10 rupees, which is the NAV of 10 rupees. Investment made was 1 lakh. Then on 31st of 2008, 31st March 2008, dividend was paid, which was 10%. And Mr. X found that his annualized yield was 153.33%. On 31st March 2009, we had like 20% dividend given. Right? And on 31st March 2009, Mr. X redeemed all his balance of 11,296.11 units. And his annualized yield was 73.52%. Then we have to get the NAVs on these dates. Okay, so how do we go about calculating the NAVs on these dates? We'll do it, let's say, step by step. So over here we have like annualized yield given to us, which is 153.33. Okay, we have been given like dividend of 10%, correct? And if you see that initially we had 10,000 units, but when we are exiting the investment, the number of units is 11,296.11. So how is this possible? How is this possible? Initially we had 10,000 units. By the time we are exiting it, we are having 11,296.11 units. How is this possible? Yeah, guys, how is this really possible? Can I say this is due to the fact that the dividend which was given to you, it was not cash dividend. Against that cash, whatever is that amount of cash, against that cash, you were allotted additional units. So every time there has been a declaration of dividend, the amount of dividend has not been given to the investor in the form of cash. Rather, it has been reinvested. Right? It has been reinvested in the mutual fund itself. Correct? So keeping that in point, we'll have to solve this entire question. Right? So we can say since number of units have increased, it means dividends have been reinvested, given to investor in the form of new units. Okay. Sure. So let's get started, guys, with the first aspect. As on 31st of March 2008. As on 31st of March 2008, we don't know what is the NAV, but we have the information about the annualized yield. As on this date, we can definitely get the amount of dividend, right? So dividend will be simply 10% of 10 rupee face value, right? Remember, dividend will be always paid to you as a percentage of face value. So 10% of 10 rupee face value into 10,000 units. So that will be 10% into 10,000 units into NAV of 10, which is 10,000 rupees. So the amount of dividend stands as 10,000 rupees. So amount of dividend is 10,000 rupees. Then this particular 10,000 units, 10,000 rupees is actually plus, in addition to that, the new NAV is giving you an annualized yield of 153.33%. Right? So that is giving you an annualized units of 153.33%. Now, I would like to know what is the, how do we get this annualized yield? Well, annualized yield, we know it is computed as NAV 1 minus NAV 0 plus dividend, right? NAV 1 minus NAV 0 plus dividend divided by NAV 0. So NAV 1 minus NAV 0 plus dividend divided by NAV 0. Now, instead of saying it as NAV 1 and NAV 0, I can simply say the value of investment and do the other calculations also. Now over here, of course, NAV 1 is something which we don't know, but rather wait. This is annualized yield, right? But our date from 1st of July 2007 till 31st March 2008, this is not a full tenure of 12 months. So how do we really make this as an annualized figure? Because this is just the return for the given period. NAV1 minus NAV0 is just the return for a given period, right? So how do we make it an annualized figure? We need to multiply it by 12 by 9. So why 12 by 9? Because 12 by 9, because the tenure over here is from 1st July 2007 till 31st of March 2008. So this return that we compute, NAV1 minus NAV0 plus dividend, that is for 9 months tenure. And we want it for like the full year, right? So taking that into account, you can say NAV1 is something which we don't know, minus NAV0 was 10, plus what was the dividend that we had? Dividend on each unit, you can say, because we are calculating over here on a per unit basis. So it's like 10% of 10 rupee, or rather, you know what, since the this calculation over here involves the number of units, instead of saying the NAV, I can actually say value of investment, or value of investment in time 1 minus value of investment in time 0 plus dividend upon value of investment in time 0. And then, of course, we do the adjustment for the time period. Okay. Now, we don't know what's the value of investment in time 1 minus value of investment in time 0. Value of investment in time 0, we had an investment of 1 lakh. Plus the amount of dividend which has been given to us, that is like 10,000, right? And then we divide it by 1 lakh and adjust it for the tenure. And we know that annualized yield at this point is 153.33%. That's 153.33%. Right. So now we can just solve it and get the value of our investment in this time period. Yeah. So what's the value of our investment in this time period? Market value of the investments. So we can simply say that it is 153.33% into 1 lakh into 9 divided by 12. And this is equal to value of investment in time 1 minus 1 lakh plus 10,000. So that's minus 90,000. Okay. So we can say value of investment in time 1 is 1,14,000 plus 90,000, which stands as 2,04,997, or roughly you can say it's 2,05,000 sort of thing. Right? So 2,04,998 or 2,05,000 sort of thing. That's okay. So this is the value of our investment in time 1, that is as on 31st of March 2008. Right. So this is our value of investment. Now, of course, over here we can get the NAV. NAV on 31st of March 2008. 31st of March 2008 will be this 2,04,998 divided by initial units of 10,000. 2,04,998 divided by 10,000. So NAV actually works out to be 20.50 as on this date. So NAV as on 31st of March 2008 is 20.50. So if the NAV is 20.50, can you tell me what will be the units allotted What will be the units allotted as dividends? Can anyone tell me what will be how to get the number of units that will be allotted to us as dividends? Yep. How do we calculate the number of units that will be allotted to us? Yeah, guys, how to get the units that are allotted to us? Because we say that 20.5 is the NAV. And what was the amount of dividend that was declared by the company? Amount of dividend that was declared by the mutual fund was 10,000 rupees, right? And of course, the units that will be allotted are 10,000 rupees divided by 20.50. So the units that are going to be allotted are 10,000 divided by 20.5, which is 487.81 units. 487.81 units are the number of units that are allotted to us. Correct? So as on 31st March, I can say we have got the NAV, we have got the value of investment, and also, of course, the units that are allotted as dividend, which is 487.81. Perfect. So now, total units after dividends will be like you had 10,000 plus 487.81. 10,000 plus 487.81. Right. So this is 10,487.81. Now, next time when you are going to get the dividend on the next duration, will you be getting the dividend on your original 10,000 units or the combined 10,487 units? Of course, the combined 10,487 units and not only on those 10,000 units. Okay. Because the next time dividend that will be declared, obviously on the face value, and the face value will be multiplied by this number of units. Okay. So that's the first story that we had. Now it's time for us to go for the next thing, where we are going to compute the NAV as on 31st of March 2009, because we have been given a dividend of 20%. Okay. So dividend is allotted to us as 20%. Now here the calculation is going to be pretty more simple. See, as on 31st March 2009, first let us compute the amount of dividend. So amount of dividend will be, it's like 20%. Amount of dividend is 20%. 20% of 20%, or rather it will be 20% into 10 rupee face value into 10,487.81. Right, so 20% into 10 into 10,487.81. This multiplied by 20% into 10. So the amount is 20,975. This is the amount of dividend that we are giving. Okay. From the given information, by the way, this is the number of units as on 31st of March 2009. That is the number of units as on 31st of March. No, sorry, as on 31st of March. This is not after allotment, right? So on 1st of April, 2008. Sorry, 1st of April 2008. This is the number of units that are allotted to us, and we have the amount of dividend. We have the amount of dividend available with us, and we have been also given the number of units that we have on 31st of March 2010. number of units as on 31st of March 2010, which is 11,296.11. Right? So number of units is 11,296.11. And on 1st of April 2008, we have like 10,487.81 is the total units which are there after dividend. We have the number of units as on 31st March 2010 to be 11,296. Can you think of the number of units allotted as dividend on 31st of March 2009? Number of units which are allotted to us as dividend as on 31st of March 2009. Can I simply say, sir, number of units that you might have allotted will be simply the difference between these two number of units, which is 11,296, because this is the number of units that we are redeeming. This is the number of units which we had, before that. And then, of course, we simply have to take the difference. So this is 11,296.11 minus 10,487.81. So this is like the difference between them is 808.30. So number of units allotted as dividend is 808.30. Right? Okay. Now, since we have the number of units which are allotted to us as 808.30, and the amount of dividend translates to 20,975.62, can you tell me what would be the NAV as on 31st of March 2009? What will be the NAV as on 31st of March 2009? Because as on that date, the amount of dividend is given to us, but we don't know what is the number of units, the NAV at which would have been allotted. So how do we get the NAV? Simple. NAV as on 31st of March 2009 will be this 20,975.62 divided by 808.30. So the units that are allotted to us, NAV as on that date is 25.95, because we have been given the amount of dividend. So the amount of dividend is 20,975, and the number of units which are being given to us as the dividend is 808.30. So we just take the different, just took the division of it, and we get the NAV as on 31st of March to be 25.95. Got it, guys? Yes, everyone? Okay, so that's the second part which we have done, which is NAV in the second year. Now for NAV in the third year, we have units as 11,296.11 and annualized yield is 73.52%. Annualized yield is 73.52%. Units are 11,296.11. Okay. We have to get the NAV. How do we go about looking at the NAV? So for that, again, we have to simply use the annualized return formula. So as on 31st of March 2010, as on 31st of March 2010, there's no dividend, right? As on 31st of March, there is no dividend as such. So we are just, redeeming the entire value. So as on this date, we can calculate the annualized yield to be equal to, again, value in time period 1, or rather I can say it's not value in time period 1, but I can say this is value as on 31st of March 2010 minus value as on the initial investment that we had. When did we have it? Say we had it on 1st of July. So the entire duration, 1st of July 2007. Right? So 1st of July 2007, value as on 31st of March 2010 minus value as on 1st of July 2007 divided by value as on 1st of July 2007, right? And of course, we are going to adjust it with the number of months. So can you tell me how the adjustment is going to be with regards to the number of months? Will be, of course, into 12 by what?
21.
How many months have really passed, guys, for this entire?
21.
21.
Yes, 12 plus 8, 9. Oh, sorry. 8, 9, 9, 10. Sorry. 24 plus 9, 33.
33, correct? So this is for 33 months, correct? So into 12 by 33. So what's the annualized yield? Annualized yield given to us on that date is 73.52. So this is 73.52%. And this is equal to value as on 31st of March 2010. That is something which we don't know. So that's simply going to remain as it is. And minus value as on of 1st of July 2007. It was like 1 lakh. And again, it is divided by 1 lakh into 12 by 33. Right. So now we can simply adjust this as 73.52% into 10,000 into 33 divided by 12. This is equal to value on 31st of March 2010 minus 1 lakh. So finally, we can say value as on 31st of March 2010, value as on 31st of March 2010 equal to, it is 2,02,180 plus 1 lakh. So the value comes out to be 3,02,180. Right. So finally, what should be NAV as on 31st of March 2010? This will be, of course, the 3,02,180 divided by the number of units. Number of units are basically this 11,296.11, and that will essentially give us the answer to be 26.75. Right, guys? So we got the NAV as on 31st of March 2010 to be 26.75. So it's like the question is pretty small, but then it requires a good amount of common sense and strong wit to crack it easily. Are we good with this question, everyone? Question number 13. Are we good with this? Yes. Okay. Then look at this question number 14. Look at this question number 14, guys. Is it similar to question 13 and can you solve it? Yes, it is. Yes. It's pretty much similar to the question number 13. I think you can just solve
Almost
it.
same.
Almost same.
Almost same except text.
Except?
Text. This is NF1. Earlier one was purchased. That's all.
Okay,
And figures are different.
So anyways, that's just the face value. Anyway, the face value is still remaining the same.
Yeah.
Okay, so you can just take this question 14 as homework. Let's go for the next question. Question number 15. Okay, so a mutual fund having 300 units has shown its NAV of 8.75 and 9.45 at the beginning and at the end of the year respectively. The mutual fund has given two options. One is pay rupees 0.75 per unit as dividend and rupees 0.6 per unit as a capital gain, right? Or these distributions are to be reinvested at an average NAV of 8.65 per unit. So mutual fund is having a total units, 300 units. Opening NAV and closing NAV is given. So the mutual fund is giving you two options. Either you get a dividend of 0.75 and 0.65 as a capital gain distribution in form of cash. And second is these distributions are to be reinvested at an average of 8.65 per unit. So basically, if they are going to be reinvested, the money will be kept with the mutual fund. It won't pay out. What difference would it make in terms of return available? And which option is it really going to be preferable for us? Now, when you say that it is going to be reinvested, of course, due to the reinvestment part, you will be getting additional units. These distributions are to be reinvested. So when you say the mutual fund declares this distribution, but it doesn't pay out in the form of cash, it undertakes a reinvestment of it. So of course, the reinvestment will be by giving you some additional units. So let us see which of these two things are going to be favorable. Okay. So the first case is distributions as cash. Okay. So we have NAV 0 to be 8.75 and NAV 1 to be 9.45. Now the mutual fund has given you two options. Pay rupees 0.75 per unit as dividend and 0.6 per unit as capital gain. Okay. So if that is the case, then we can simply get the annual yield of the mutual fund as NAV in year 1 minus NAV in year 0 plus dividend distribution plus the distributions that are divided by NAV 0. So this is like 9.45 minus 8.75 plus the distribution, which is 0.75 and 0.60. So 0.75 plus 0.60 divided by opening NAV of 8.75. So annual yield that we have is 9.45 minus 8.75 plus 0.75 plus 0.6 divided by 8.75. Then it is 23.43%. So annual yield is 23.43% if you are going for a distribution in the form of cash. Of course, we have the second case also with us. So case 2 is distribution as units. So the distributions are going to happen in the form of units. We need to first compute the amount of distributions. So the amount of distributions will be like 300 units multiplied by 0.75 plus 0.60. Like 300 into 0.75 plus 0.60, which is 405. So amount of distribution is 405, right? So this is the amount which is going to be distributed as dividend. But of course, we need to get the number of units also, right? So units allotted as dividend is going to be like 405 divided by, what is the price at which units are allotted? At an average NAV of 8.65. So we can say that it is divided by 8.65, which is 46.82. These are the number of units which are allotted, right? So now, what is the total number of units? Total number of units.
346.82.
Yes, it is 300 plus 46.82, which is this, plus 346.82 is the total number of units that we have. Now, after this total number of units, which is 346.82, we can get the number of, we can get the annual yield, or this is like value at start of year. Value at start of year will be like 300. We had 300 units, multiplied it by NAV is 8.75. So that is 300 into 8.75, which is 2625. Then value at end of year will be 346.82 into 9.45. So this multiplied by 9.45, which is 3277.45 possibly, or 46. And then we can get the annual yield by simply doing a substitution as 3277.46 minus 2625 divided by 2625. This is equal to like 24.86%. Right? So for the second option, we get a yield of 24.86. And in the first option, we are getting a yield of 23.43. So out of these two, which one would you like to really choose? Which of, the question asks us, what difference would it make in terms of return over, and which option is preferable? So which option is preferable? Of course, case 2, even though the units are allotted to us at a lower NAV, so even though units are allotted at a NAV of 8.65, but these units are actually having a are providing a better value, and therefore the return is marginally better in case of the second option. Okay, are we good, guys? Yes. Everyone's perfect. Yep. Okay. Then,
Sir,
yeah.
Sir Abrakesh.
Yeah. Bhuvnesh.
Sir, in case of case 2,
Mhm.
for calculating value at the year end, we should multiply it 9.45 or 8.65.
No, 9.45. Because when the distributions were made to you, at that time the NAV was 8.65. Like the dividend and
Yes.
distribution would have been done during the year, right? So when during the year
Yes.
units were given to you, at that time the NAV was 8.65. But as on year end, it is 9.45. As on end of the year, the NAV is 9.45. So the units that you have even received in the form of dividend, that would be valued at 9.45.
Okay. Thank you.
Okay. Okay. Let's go for some more questions. There are a lot of questions to discuss. Good variety of questions we've got. Let's do this question 17 first, guys. Question number 17, Sun Moon Mutual Fund. Now, before I go ahead with the solution, before we go ahead with the discussion, I want you to just go through this question a bit. I'll just give you a minute's time. Take a minute's time and just try to run through the question, guys. Look at the numbers, look at the statements that they have given in the question. Try to assimilate into what the question is really talking about. Okay, so let's start the discussion, guys. So we have like Sun Moon Mutual Fund, approved mutual fund, sponsored open-ended equity scheme uh, called as Chanakya Opportunity Fund. And under that, they have given like three options, three plans for the investors. One is Plan A, which is dividend reinvestment. So whatever in Plan A, whatever dividend is being declared, remember, whatever dividend is declared, that is for Plan A. So this dividend percentage is for Plan A. And then we have like Plan B, which is the bonus plan. So this bonus plan is for Plan B. And Plan C is the growth plan. Now, what happens in a growth plan? In a growth plan, no dividend, no capital appreciation, distribution, nothing is paid out by the mutual fund. Okay, nothing is paid out by the mutual fund, right? And the money keeps on accumulating in the mutual fund, and then it keeps on growing, right? So no dividend, no capital gain distribution, nothing will be done in Plan C. That's a growth plan. At the time of again, this is new fund offer as on 1/4/99. Mr. Anand, Mr. Bachchan, Mr. Charu. So ABC, three invested in. Now remember, Anand has made an investment in, Anand has made an investment in Plan B. Bachchan has invested in C, and Charu has invested in A. Okay, so we would like consider only the plan performance. So we'll say performance of plan A, B, and C, and not names the specific investor. So we have been given odds on those dates, what are the dividend, what is the bonus ratio given to us. Then on 31st July, all three investors redeemed all the balance units. So all our three investors redeemed the units. Calculate the annual rate of return to each of the investors, considering the long-term capital gain is exempted from income tax. Short-term capital gain is subject to 10% income tax. Security transaction tax is 0.2% only on sale or redemption of units. And we have to ignore any education cess. Okay. So we started with the time on 1/4/99, and then the dividend bonus and everything keeps on coming from 28th of September 2003 onwards. Okay. So let us calculate the performance or the rate of return, annualized rate of return from each of these plans. So we'll say evaluation Ms. Charu's plan A, which is plan A is for dividend reinvestment. Evaluation of Mrs. Charu plan A, which is dividend reinvestment. Date, investment, right? Then we have like the amount of dividend is given to us for each of these. So let me just write down investment, but let me write down the NAV date as on that date, whatever is the amount of NAV. Then we'll say the opening units, right? NAV, date, NAV, opening units. Then we'll say the dividend percentage, right? Then amount of dividend, date, NAV, opening units, dividend percentage, amount of dividend, and then units of dividend units, I could rather say. Dividend units, right? Then after that, we will get the closing units. Okay. So these are the columns that we have for calculation. So we have been given like multiple dates, right? And NAV is given to us. Opening units will be same as the closing units. Dividend percentage, that's also given to us. Now the amount of dividend will be computed as dividend percentage multiplied by amount of dividend will be computed as dividend percentage multiplied by opening units, dividend percentage multiplied by opening units, and then multiplied by 10 rupees. Just putting up the formula. Then, how do we get the dividend units? Well, the dividend units will be obtained as, the dividend amount, right? Divided by NAV, right? Right. So this is what the headings are going to be for our table. Then let's get started with the first thing. As on 1/4/1999, NAV is going to be, of course, 10 rupees. Opening units will be, opening units is basically 0 because we don't have any units purchased, right? So closing units will be, of course, 10,000 because 1 lakh was invested. Okay. Then let's get started with the first part, which is 28th of September. So 28th of July, 2003. 28th of July, 2003. So NAV as on this date is 30.7. Okay. And dividend percentage is 20%. Let's write down all the dates and the respective, NAV and the dividend. So that's easy for us to calculate the thing, because otherwise we'll have to refer again and again back to the 31st of March 2004, 31st of October 2007, then we have 15th of March 2008, 24th of March 2009, right. So the dividend percentages, let me first write down the NAVs. As on 31st of March 2004, NAV is 58.42. This is 58.42. Then we have next NAV as 42.18. Then it is 46.45 and 48.10. Right. 48.10, 46.45, 42.18, 58.42. So these are the NAV values. Let me write down the dividend percentages also. This is 20, and we have 70, 40, 25. 70%, 40%, 25%, and 40%. Okay, so now based on this, let's do the other calculations. So like as on 28th of July, we had the opening number of units to be 10,000. Now the amount of dividend will be simply the dividend percentage multiplied by the opening number of units, right? So dividend percentage into opening number of units into 10. So the initial dividend, the first dividend is 20,000. Now the dividend units that will be allotted to you will be, of course, the amount of dividend divided by the NAV as on that date. So dividend that is allotted to you, or dividend units that are being given to you, is 651.47. Closing units will be amount of dividend plus the dividend units, right? So which is 20,000. Sorry, my bad. Opening units plus 651.47, which is 10,651.47. Right. So that's the closing units which we have. Now that same closing units will be the opening units as on 31st of March 2004. Now, since we have this dividend percentage given to us, we can get the amount of dividend again, which will be dividend percentage into opening units into 10 rupees. That's amount of dividend is 74,560. Let me just make that clear that this is, something in the form of currency. Okay, because the rest everything is in the term of units. Right? Even NAV is currency. NAV is in INR terms. So dividend units will be the amount of dividend divided by NAV. The units that are allotted to us is 1276.28. So the closing units will be the opening plus the dividend. Okay. So I'll just give you a couple of minutes to quickly calculate the dividend units and closing units for the remaining 3 instances. Please do the calculation and post it in the chat box so that I can see your participation, and then we will definitely go ahead with the further calculations. Please calculate these 3 points, guys. You should be able to do it, and just do it in rough work also. Just scribble it around with your pen or pencil. All the data is there on the screen for you. Guys, give me the number of units which are allotted as dividend, because that is something which is crucial for calculation. Give me the number of units for each of these instances. Okay, 1131.13, 702.85, and 1144. So these are the number of units that are allotted as dividend, and the closing number of units is also available, which is 14,906.15. Yes. Okay, guys. So with the other units available with us for at the end, which is as on maybe 31st of July, when we are simply selling it out. So let us look at the calculation of the return, because ultimately we have to get the annual rate of return that an investor is getting. we'll first get the sale value or redemption value of units. Redemption value of units. So it will be 14,906.15 multiplied by 14,906.15 multiplied by what's the NAV? It is 53.75. Yes, that's 53.75. So the redemption value is which is 8,01,205.3. That's the redemption value. Now from that we are going to subtract the securities transaction tax, because every time we are doing a redemption we need to pay a securities transaction tax. Securities transaction tax is 0.2%. So securities transaction tax is this multiplied by 0.2%. So 1602 will be the amount of securities transaction tax that we are going to pay. So the net redemption for us is going to be 7,99,602 or 603. So this will be like net, not redemption, but net amount received, we can say. Right now, of course, from this, I need to reduce the short-term capital gain tax. Now, short-term capital gain tax is at the rate of 10%. Right? Short-term capital gain tax will be at the rate of 10%. Now, is this short-term capital gain tax applicable to all the units? Of course not. We know the units which were allotted to you a year before redemption. A year before redemption is what we have to consider. The short-term capital gain tax a year before redemption, it's like which are the units, because we are redeeming this as on 31st of July 2007. Right, 31st of July 2007, we are undertaking the redemption. So before 31st of July 2007, sorry, my bad, 31st of July 2009. Yeah. So just before 31st of July 2009, which were the units that were allotted to you? Which were the units that we will count? Which were the units that we are going to count? Are we going to count all the units that we have received as dividend? Or are you going to count like the total cumulative dividend that we have? No, the dividends which were allotted to you, the units that were allotted to you within a year of your sale, or within a year before the sale, that is only going to be counted. The short-term capital gain tax will be applicable only on these units, which is 1144.43. So this is 1144.43, right? On these units, we are going to calculate the short-term capital gain tax. Now, short-term capital gain tax, of course, this is the units multiplied by the redemption value is 53.75, right? Minus, this is the sale value. Right? What will I consider as the purchase? What will I consider as the purchase cost or cost of acquisition in the taxation terms? This is like 53.75. No, we can't take 53.75 also, because I need to adjust the STT over here. So 53.75 into, we can say 1 minus 0.2%. Right? Because I'm just doing this for the purpose of adjustment it as a STT, which is after tax sale value. So 53.75 into 1 minus 0.2% minus, this is the net net realization or net proceeds. Right? This is the full value of consideration, which you can say. From that, STT is subtracted. Now, what should be the cost of acquisition for these 1144.43 units? what do you think? What should be the cost of acquisition? Yeah, guys, what should be the cost of acquisition for these units? What do you think? What should be the cost of acquisition?
48.1 per unit.
48.1.
NAV on 20.
Okay. So NAV as on this date is like 48.1. Now, if you are going to consider this, you're correct. Now, you may also argue that these were the reinvested things, right? So the investor has not actually paid in cash anything. The units are allotted to him, free of cost. So you can also take zero. Both ways are correct, right? But right now, let me take it as 48.10. Even if you take this purchase cost or the full value of sorry, the cost of acquisition to be zero, that is also acceptable. Okay. So 1114.43 into this. Let me just calculate the value of this 6343.00, right? So net amount received is 7,99,602.9, and then short-term capital gain is 6343. Right, and of course this needs to be multiplied by 10% also, guys, because the short-term capital gain tax is computed as 10%. 10% multiplied by this gain value, which is 634.3. And of course, once we subtract that, we get the net redemption value. Net redemption value is 7,99,000 minus this, which is 7,98,963. This is the net redemption value. And then we have like the investment. So we can get the gain out of it. Less investment of 1 lakh. We get the gain. So gain value is 6,98,968.6. Okay, so that's the gain value. Now, once we have this gain value, we can of course get the annual return also. Annual rate of return will be, what was the initial investment we made? We made an investment of 1 lakh, and on that we are making a gain of 6,98,000. So annual gain will be 6,98,968 divided by 1 lakh, and then we just adjust it for the time period. Now adjusting it for the time period means what should be the tenure? Of course, it should be multiplied by 2, but what is it going to be divided by? 6,98,968.6 divided by 1 lakh into 12 divided by what should be the number of what should be the number of months? Because you will have to count the months from 1499 till 31st of July 2009. So if you look over here, from 1st of April till 31st of March 2009, it will be a total of 10 years. Plus April, May, June, July, 4 months additional. So 10 years means, of course, 120 months, and that you add to that 4 months, right? This is like 124. This is 6,98,000 divided by 1 lakh into 12 divided by 124, which is 67.64%. 67.64% is the annual rate of return on this particular scheme, which was the dividend reinvestment scheme. Is this totally clear to you guys? Is this first part of the question clear, guys? Yep. Okay, great. Now let's go for the second plan, which was bonus plan. So this was a bonus plan, the second plan. Let's go ahead with that calculation now. So we'll say evaluation of bonus plan was taken by Mr. Anand, right? Evaluation of Mr. A. Anand, plan B, which is the bonus plan. Okay, so here we can look at the dates. Then we can simply say we don't need NAV over here, but still I'll write it down. We have the bonus ratio. Then talk of what is the opening units. Then the bonus units. And then the closing units. So date is given, NAV is given, so let's write it down. So how many times you have received bonus? You have received a total of bonus in. You received bonus 3 times. Okay. Yeah. So bonus is being received by us 3 times. So let us consider only those dates in our calculation. So first is 1st of April 99. And then we have bonus on 31st of March 2004. Right. This date NAV is 10. Then as on 31st of March 2004, the NAV of the fund is 31.05. Then the next bonus happens to be on 31st of March 2008. 31st of March 2008, which is 20.05 NAV. And then we have as on 24th of March 2009. NAV is 19.95. And then, of course, the redemption, we can get it as later on. Now, the bonus ratio, of course, this is not applicable. Here, the bonus ratio is 5:4. Then it is 1:3. And then it is 1:4. So opening units we have the opening number of, initially we of course got 10,000 units, and every time we are going to have the bonus units. So bonus will be like, of course, not applicable in the first case. In fact, opening we didn't have only as on anything. So we got a closing. Now 31st of March 2004, there's a bonus of 5:4. So we had an opening of 10,000 units, but then we have got a bonus of 5:4. The bonus units will be 5:4 means 5 bonus units for every 4 existing shares. So we can say 10,000 divided by 4 multiplied by 5. So these are the bonus units. So closing number of units will be bonus plus opening. Then opening units will be equal to closing. Bonus units will be again 22,500 divided by 3 because the bonus ratio is 1:3. So that will be divided by 3. So closing number of units will be 22,500 plus 7,500, which is 30,000. Then the opening units is same 30,000. Bonus units will be opening units divided by 4. So bonus units will be 7,400. 30,000 plus 7,400, which is 37,500. So that will be closing units 37,500, and as on date, the NAV is 19.95. Now, let us first get the gross redemption value. So gross redemption value is like 37,500 units multiplied by what's the NAV as on the redemption date? It is 22.98. 22.98. This is 22.98. So gross redemption value is 8,61,750. From that, of course, we are going to subtract the STT at the rate of 0.2%. Right? So STT is, this multiplied by 0.22%. Again, we will subtract the short-term capital gain tax. Short-term capital gain tax. Now, of course, the short-term capital gain tax will be applicable only on this 7,500 units because we are redeeming this as on 31st of July 2009. So as on 31st of July 2009, we are redeeming it. So we need to look at the units that are allotted to us a year before. So the units that are allotted to us, 7,500. Short-term capital gain tax applicable only on this 7,500 bonus units. So short-term capital gain tax will be 10% multiplied by 7,500 units into, again, the full value of consideration and the cost of acquisition. Okay. So full value of consideration will be 22.98 into 1 minus 0.2% to make it a net of STT number. And then from that, 22.98 into 1 minus 0.2% minus, they're going to subtract. We're going to subtract the cost.
STT is 1723.5.
STT, oh, thank you. 1723. Yeah. So now we can reduce the cost of acquisition from here. Now again, you can argue the cost of acquisition of the new units can be 0, or you can also take this 19.95 because the day on which units were allotted to you, at that time NAV was 19.95. You can either ways take any one of them. That's minus 19.95. So ideally, we can say that short-term capital gain will be like 2238.03. Okay, and then we get the net redemption value. So net redemption value is this minus this. So 8,57,788.5. That's the net redemption value. Of course, from that we will reduce the investment of 1 lakh. Right. So we get a net gain of 8,57,000 minus this 1 lakh, and then we'll top off what will be the rate of return or annual rate of return. So annual rate of return is 7,57,788.5 divided by investment of 1 lakh, and then of course multiply it by 12 upon 124. Okay, so this is this divided by this into 12 divided by 124. So that is 73.33%. Annual rate of return is 73.33%. Okay. So annual rate of return stands at 73.33%, guys. That's the second plan. So of course it proves to be better than the dividend reinvestment plan, the bonus plan. We still have one more plan to go, which is Mr. Bachchan's plan C, which is growth. So let me write down the heading: evaluation of Mr. Bachchan, which is plan C. It is not a bonus plan, but growth plan. Evaluation of Mr. Bachchan plan C, which is a growth plan. Okay. Now, how do we go about this growth plan? What's the calculation for this growth plan? See, growth plan is pretty simple. There's no dividend investment, no bonus. You invest at the start of the tenure, the investment tenure ends, and then you receive the full value. So we have like simply the redemption value over here. So the redemption value is 82.07 multiplied by 10,000 units. 10,000 into 82.07. Right, so that's the redemption value. Of course, I cannot take this full value because I need to pay the securities transaction tax at 0.2% into 0.2%, which is 1641.40, less short-term capital gain tax. Will there be any short-term capital gain tax in case of growth plan, guys? Will there be any short-term capital gain tax? No, there won't be any short-term capital gain tax because there is no units which are allowed to you a year before your redemption. So, of course, short-term capital gain tax is 0. And then we say, what's the net redemption value? Net redemption value is simply 8,19,058.6. Net redemption value is 8,19,058.6. We made an investment of 1 lakh. So we get the net gain of 7,19,058.6. So what's the annual rate of return? Annual rate of return is like 7,19,058 divided by 1 lakh. And of course, multiply it by the time factor. Into 12 divided by 124. Okay, so that gives us like 69.59% as the annual rate of return. So our annual rate of return stands at 69.59%. So what was the conclusion? We just have to calculate the annual rate of return. So best plan turns out to be like the 73.33 annual rate of return. So annual rate of return 73.33. That's the best plan which is applicable. So we have this numbers available with us. And that completes this question number 17 for us, guys. Right? Okay, then just have a look at this question number 18. Have a look at this question number 18, guys. Can you solve it? Question 18. Yes, it is similar. Instead of giving you, 1 lakh investment, the amount of investment is 2 lakh. And the percent, the NAV is given to us. You will get the number of units which you would have acquired. And then the rest calculation remains just the same. Okay. So rest all calculation remains the same. Okay. So we can say this is your homework for you. Let's go ahead with question number let's do question 20 now. So it is question number 20. Based on the following information, determine the NAV of a regular income scheme on per unit basis. Regular income scheme on a per unit basis. So we have like listed shares at cost 20 crores, cash in hand, bonus, and cash in hand bonds and debentures at cost of these bonds not listed and quoted. So there are some information given to us. I want you to just quickly go through the information. Please go through the information, go through the question, and then we can start with the solution and its discussion. Okay. Listed shares at cost, ex dividend is 20 crores. Then we have cash in hand 1.23 crores. Bonds and debentures at cost, which is 4.3. Of these bonds not listed and quoted, again 1 crore. Other fixed interest securities at cost is 4.5 crores. Dividend accrued is 0.8. The amount payable on shares is 6.32. Expenditure accrued is 0.75. Number of units, rupees 10 face value is 20 lakhs. Current realizable value of fixed income securities of face value rupees 100, 106.5. Listed shares were purchased when index was 1000. Present index is 2300. Value of listed bonds and debentures at NAV date is given as 8 crores. There has been a diminution of 20% in unlisted bonds and debentures. Other fixed interest securities are at cost. Okay. Based on the following information, we have to determine the NAV of a regular income scheme on a per unit basis. Now we have the listed shares, which is at a cost, X dividend of 20 crores. Cash in hand, other things are given. We have to get the NAV. Now we can, of course, calculate the NAV by simply taking the total of assets and minus the total of liabilities, and then simply divide it by the number of units. Okay, so let's write down the information. Question number 20. So we have like listed shares at a cost. So let's write down the details of the assets. So equity shares, listed shares at cost. So cost is like 20. And so cost is given as 20. Whereas if you look at current value, how do we get the current value? Have they given us any information? Present index is 2300, and when the shares were purchased, then the index was 1000. So the cost is given as 20, but this 20 divided by listed shares were purchased when index was 1000. So when the index was 1000, then we had like purchased it. So 20 divided by 1000 multiplied by present index is 2300. So this is 20 divided by 1000 into 2300, which is 46. So equity shares are 46. 46 crores is the current value of the equity shares. Then the next asset that we have is cash in hand. So cash in hand is 1.23. Bonds and debentures at cost. So we have like bonds and debentures at cost, which is 4.3. Bonds and debentures at cost is 4.3. But again, there we need to give the bifurcation as out of them, some of them are listed, some of them are unlisted. So of these bonds not listed and quoted, so basically the bonds which are having a unlisted bonds. So there we will talk of the listed bonds and unlisted. So regards to the unlisted bonds, they say there has been a diminution of 20%. So unlisted, it was like 1, and then you multiply it by 80% because there has been a diminution by 20%. So it is 0.8. What about the listed? Listed debentures, listed bonds value. Bonds and debentures which are listed. Value of listed bonds and debentures at the NAV date is 8. So listed debentures are trading at 8. Then next we have bonds are done. Bonds and debentures at cost. Of these bonds not listed and quoted, 1. Other fixed interest securities at cost. So of these bonds which are not listed and quoted is taken. Now other fixed interest securities at cost is 4.5. So fixed interest securities Other fixed interest securities, the question says, are to be valued at cost. So other fixed interest securities. So other fixed interest securities at cost are 4.5. Other fixed interest securities are 4.5. Then the next is dividend accrued. So which is basically dividend receivable. Dividend receivable is 0.8, or dividend accrued is what you can say. Dividend accrued is 0.8. Do we have any other assets? Rather, there is an amount payable on shares. So this is a liability, and expenditure which is accrued is again a liability. So we can say this is total assets is simply the sum of all of it, which is 61.33. Okay. Then from that, we will reduce the liabilities. So liabilities are amount payable on shares and the accrued expenditure. So amount payable on shares, which is 6.32, the certain amount that is due on shares, and then the expenditure accrued. Expenditure accrued is 0.75. So we can say net assets is simply the total assets minus the sum of these two, which is 54.26. And then we say number of units. So number of units is 20 lakhs. So this is 20 lakhs. So I can say this is 0.2 crores. So all of these numbers are in crores. So we get the net asset value to be simply 54.26 divided by 0.2, which is 271.3. Okay. Yes, Pooja. You want to ask something?
Sir, question has given us current realizable value of fixed income securities. What to do with that value?
Current realizable value of fixed interest securities. So that is current realizable face value of rupees 100. So for every 100, they are saying that current realizable value is 106.5. But then the question says other fixed interest securities are to be valued at cost. So as the question explicitly gives us that they have to be valued at cost, we are taking it at cost itself.
Means in case the question does not mention that, we have to use that 106.5 value.
Yeah, then you will have to adjust it, like whatever been the cost, they would give you what is the cost at which you purchased and what is the current value of it.
Okay, sir.
You need to multiply it.
Yes,
Okay.
sir.
Okay. Yeah, okay.
Sir, why 20% is be removed for considering unlisted bonds?
Unlisted
we have
bonds,
multiplied 1 by 80%.
Yeah, 20% there has been a diminution, right? So a value, whatever could be the value of bond,
Okay.
20% has been provided for.
Diminution.
Diminution,
Okay.
yes. So 80% is only left.
Yes, yes. Okay. Yeah. Thank you, sir.
Okay, so that's question 20 for us. Then let's take a break, guys. Take a break of 10 minutes and then we'll come back and continue doing few more questions from this chapter. Okay, take a break, guys. So we have done like question number 20. Question number 20 is done. Now let's look at question number 19. Guys. A mutual fund made an issue of 10 lakh units of rupees 10 each on 1st January 2008. So there have been a issue, or I can say NFO, with an NAV of 10 rupees as on January 1, 2008. No entry load was charged. It made the following investments. 50,000 equity shares of rupees 100 each at rupees 160, which is 80 lakh. 7% government securities, 9% debentures unlisted, 10% debentures listed. So the total is, amounting to 98 lakh. Okay, the amount that we collected was 10 lakh into 10 rupees, which is 1 crore. So out of 1 crore, 98 lakh was invested. Okay, out of 10 crore, out of 1 crore, so 98 lakh was invested into the securities. During the year, the mutual fund received a dividend of 12 lakh. Interest on all types of debt securities was received as and when due. At the end of the year, equity shares and 10% debentures are quoted at 175%, 90% respectively of the face value, and other investments are going to be valued at par. Find out the NAV per unit, given that the operating expenses paid during the year amounted to rupees 5 lakh. Also find out the NAV if mutual fund distributed 0.8 per unit during the year to the unit holders. During the year to the unit holders. Okay, so let's go about calculating the NAV over here, because we need to look at the movements in cash that are happening also. Okay. Question 19. First, let's look at what is happening in the cash, like opening cash balance. Opening cash balance is 2 lakh. On that, we have received a dividend of 12 lakh less dividend received of 12 lakh. Interest on all types of debt were received as and when due. And of course, so interest is something we would have received on 7% government securities, 9% unlisted debentures, 10% listed debentures. So we'll say add interest on 7% securities, 7% government securities, which is 8 lakh into 7%. Then interest on 9% debentures, interest on 9% debentures, 5 lakh into 9%, right? Then interest on 10% debentures, add interest on 10% debentures, which is 5 lakh. So it's 5 lakh into 10% is the amount of debentures that we would have received. Then other, at the end of the year, equity shares and debentures value are given Other investments are valued at par. Okay, find out the NAV per unit. Given that operating expense paid during the year amounted to 5 lakh. So we need to reduce operating expenses paid. Operating expenses paid will be 5 lakh. I'll just take this numbers. Why did I subtract it? Okay, so operating expenses paid is done, and then we can say the net assets. So net assets will be sum of all of them, right? And then you say the number of units. So number of units, oh, sorry, my bad. It's a closing balance, right? Closing cash balance, right? Then let's compute the NAV. Calculation of NAV. We have cash balance of 10,51,000. Then we have the government securities. Let's write down the assets that we have purchased. Assets are 7% government securities, 9% debentures, and 10% debentures, and 50,000 equity shares. So we'll say the equity shares value, 7% government securities, then 9% debentures, then 10% debentures. So equity shares, they're saying during the year 12 lakh was at the end of the year, equity shares, and 10% debentures are quoted at 175% and 90%. So when we say 175%, so it means the equity shares are of face value 100. So when they are quoted at 175%, of course, it's going to be 1,75,000. 175 being the per share price. So calculation wise, we can say it is 50,000 multiplied by 175. So it is 50,000 into 175. That's the value of equity shares. Then 7% government securities are to be valued. Other securities are to be valued at par. So when they say they are valued at par, it is going to be remaining same, which is 8 lakh. 9% debentures Again, that will be valued at par. 10% debentures. 10% debentures are quoted at 90% of their face value. So 10% debentures were invested for 5 lakh. So simply going to be 5 lakh into 90%. That's 4,50,000. Then we say that we have total assets. Total assets is this much. Then let's write down the number of units. Number of units are 10 lakh. Right. So we say NAV per unit will be simply 11.55. Right. Then they say also find out NAV if the mutual fund had distributed a dividend of 0.8 per unit during the year. So if you would have distributed dividend, then what would have been the case? In that case, the only change that we will see is in the cash, right? Total assets if dividend distributed. Total assets if the dividend is distributed. If the dividend is distributed, we can say the total assets will be reduced to the extent of dividend distribution. So dividend is like 0.8 per unit. So dividend distribution will be 0.8 into 10,000. 0.8 into 10,000. Oh, sorry. 0.8 into 10 lakh. Yeah, so 8 lakh is the amount of dividend which has been distributed. Total assets that we have, if dividend have been paid out, so your cash amount will get reduced by 8 lakh. So total assets will be 10 lakh 75 or 1 crore 7 lakh 51,000. Then we say the NAV per unit in that case, which is divided by 10 lakh. So that's like 10.75. Okay. Correct, guys? So that's the NAV calculation. Easy. Yes, Abrakesh ji.
Sir, where from we have got 2 lakh rupees of opening balance of cash?
See, 10 lakh units into 10. So we received a total of subscription of 1 crore.
Yes.
Out of that, 98 lakh securities is what we have invested. So we will have a 2 lakh balance in the beginning, right?
Okay.
Yeah.
Okay.
Yeah.
Thank you, sir.
Okay. Let's go for another question, guys. And this question is going to be really, really interesting. Let's look at the question number. Interesting question. Probably that would be the last question that we do today. Yeah, that's question number 20. Question 21. Please read the question, guys. Please read the question. Read the question carefully. I'm just giving you a minute's time to read the question carefully. Have you read it? Have you read the question? Tell me one word from the question where you are clueless what it is. Which is that one word from the question for which you are clueless? Sir, what is this word? We couldn't get it.
Adjusted for dividend equalization.
There is something called as adjusted for dividend equalization. Now, what is this dividend equalization? At CA Inter, you might have learned a topic called as Accounting Standard 13, I suppose, which is investment or investment accounting. Have you done that? Investment accounting.
Sir, is it related to the concept? I'm not sure of this. The dividend which belongs to the period during which I was not the holder of that share.
Yeah, it is something of
That
that sort.
dividend is balanced
Yeah,
to calculate the price
Yeah,
for which one should purchase the share.
correct. So, in CA Inter, you might have learned the topic investment accounting under Accounting Standard 13. There, you might have learned something called as accrued interest or accrued dividend sort of thing or accrued income sort of thing. We generally use it as accrued interest. Am I right? Have you heard this something called as accrued interest? Right, guys?
Yes, sir.
Yeah. So let's say, for example, interest is, one second, let me just close it and open it again. Let's say you're going to receive interest on 31st of March 2024. And if you are purchasing it, so date of purchase is, let's say, 1st of February 2024. The date of purchase is 1st of February 2024. Then I actually pay a price plus the accrued interest on this, correct? Right? So let's say debenture is purchased for maybe 98 rupees plus if the full year interest is supposed 12 rupees, we adjust it for the certain time period, right? So let's say interest is payable at 31st March every year. So how much will be the amount of accrued interest if the interest for full year is 12 rupees? Yeah, tell me. What is the amount of accrued interest? Because my interest will be payable on 31st of March. But I purchased it on 1st of February. So what will be the amount of accrued interest on this debenture or on this bond? Can I say it is into 10 by 12? Because this is the 12 rupee interest for full year. 12 is the amount of interest for the full year. Right? So 12 is the amount of interest for the full year. And for 10 months, it was held by the buyer. And we used to simply do the time adjusted things. And this will work out to be like 108. This will work out to be 108. Right, guys? Correct? Do we remember something of this sort being done at CA Inter level?
Sir, it is a sort of cum dividend. I mean,
Yes.
concept.
Yes, cum interest, ex interest, cum
Yes.
dividend, ex dividend, right? So this 12 is for the full year, and for 10 months, for 10 months, this bond was held by the buyer. And when the seller is going to buy on 1st of February, of course, when the company is going to pay the interest, who is going to get the interest? As on 31st March 2024, who is going to get the interest? Is it the seller who is going to get the interest, or is it the buyer who will get the interest? Of course, it is the buyer who is going to get the interest. But actually, seller was holding it for 10 months, correct? And buyer is going to hold it for 2 months. And this 12 rupee interest is for the full year. So ideally, 10 rupee interest is actually the right of the seller. 10 rupee interest is the right of the seller, and the buyer needs to compensate that. So buyer will pay like 10 rupees, and in turn it will receive back 12 on the date of declaration of the interest, or on the date of payment of the interest. Got it, guys? Yeah?
Yes, sir. Yes.
So something of that sort is happening over here in case of dividend equalization also. So the idea is, when in future the dividend keeps on accruing or interest keeps on accruing, and then we say that that typical interest will be actually earned. That's the right of the person who was holding the units. So we cannot give the units to other person without accounting for the same, right? So let me just go through this. On 1st April, an open-ended scheme of mutual fund had 300 lakh units outstanding with an NAV of 18.75. At the end of April, it issued 6 lakh units at opening NAV plus 2% load, adjusted for dividend equalization. Okay. So the 6 lakh units that were issued, those are going to be accounted, or they will be, of course, giving us some money for getting those units. What will be the price at which we are going to issue them the units? It's obviously going to be at an opening NAV of 18.75, right? At an opening NAV of 18.75, and that is going to be adjusted for this 2% load. And this load, is it entry load or exit load, guys? This 2% over
Entry
here
load.
is an
Entry.
right? So price is going to be adjusted for entry load, right? At the end of the May, adjusted for dividend equalization. Now, what is this dividend equalization? See, this 6 lakh unit holders, these are they are getting the units as on end of April. So are they entitled to the income that has been generated by the mutual fund in the month of April? Should they be entitled for the income of the mutual fund in the month of April, because they are going to buy the units at the end of April? Are they entitled for that?
No.
No. But when the mutual fund declares the dividend or declares distribution at a later date, maybe at the end of the year, can it do the distinction like the unit holders who have got the units on April? They will not be receiving this much portion of income. No, that sort of distinction is not done by the mutual fund. So mutual fund, on a safe side, what it does is it simply asks that whatever has been the income in the month of April, right, per unit value of that, you need to give it to us. You need to give the per unit value of that income to us, so that we will be able to do justice to you as well as the other investors, right? So let me just start with the solution. The question asks us income available for distribution, issue price, repurchase, NAV as of 31st June, 30th June. Okay. So issue price at the end of April. Issue price of units at the end of April. Issue price of units at the end of April. Opening NAV, opening NAV, because at the start of April we had the NAV of 18.75, opening NAV of 18.75. We will add to it entry load at the rate of 2%. So of course 18.75 into 2%, that's the entry load, 0.375. Add entry load 0.375. Then we just do the addition of this, which is 19.125. And of course, are we going to pay these new unit holders, or are we going to ask them to pay us the accrued interest or the accrued income portion? Should we be recovering from them or should we be paying them? Think from the mutual fund point of view. We will ask them to pay upfront, right? Correct? So we will be recovering from that and from them. So we'll say add dividend equalization. So now dividend equalization, we need to get the dividend equalization. Now how do we get the dividend equalization portion? How do we get the dividend equalization portion, guys? We have to look at what has been the income of April. Income of April is like 22.95. Income of April is 22.95, right? So that 22.95 is the income. Can you tell me this 22.95 is the income for how many unit holders? 22.95 is the income for how many unit holders? Is the income for how many unit holders, guys?
36. Sorry.
No, not 306. It will be only for 300. It will be for 300 lakhs. Because when we were earning this income, this 6 lakh were nowhere in picture. We earned this
that's true. Yes.
2.95 only on this 300 lakhs. Okay, next month when you say in the month of May, then you can count this 6 lakh unit holders.
Yes.
Count them right now. Right. So income of April is 22.95. This is earned on the income on the funds invested by the 300 lakh unit holders. Okay. So dividend equalization, we can say it will be added, but let's just try to do it in a more proper manner. We'll say calculation of income available for distribution. So we'll be like particulars, then we'll say units, amount, and then per unit. So particulars is basically, first we will say income in April. So income in April has been like 22.95, but this 22.95 is the income for how many unit holders? 300, right? So this income is for 300, and therefore we can say per unit income is 0.0765, and definitely dividend equalization will be 0.0765. Now, what will be the amount of dividend equalization? Dividend equalization collected from 6 lakh units. Dividend equalization collected from 6 lakh units. dividend equalization that's going to be collected from 6 lakh units. So we have like 6 lakh units. On that, per unit is this what we are collecting. So amount wise, how much is going to be the dividend equalization? This into 6. So 0.459 will be collected as a dividend equalization from 6 lakh units. Okay. Now, of course, on a per unit basis, since we want the issue price at the end of April, on a per unit basis, we are getting this we're getting the 0.0765 to be the dividend equalization, right? And that will be like issue price of course at the end of April. So issue price will be 19.125 plus this, which is 19.202. Did you get that, guys? That is the issue price or issue price of the units at the end of April. Is it clear?
Yes, sir.
Okay. Okay. Now, next thing is we have to get the redemption price at the end of May. The redemption price of units at the end of May. The redemption price of units at the end of May. At the end of May, the redemption is going to be at where 3 lakh units were repurchased at opening NAV less 2% exit load adjusted for dividend equalization. So here again we have like opening NAV to be remaining same as 18.75, but one second. Here there is a redemption. So there will be exit load. So are we going to add the exit load or are we going to reduce the exit load? Yeah?
Reduce.
Reduce.
They're going to pay after deducting it, right? So less exit load. Of course, exit load is also 2%. So 18.75 into 2%. This is obviously going to be subtracted 0.375. Opening NAV is 18.75. Exit load is subtracted by 0.375. So this is what we have, 18.3750. Then we will add the dividend equalization. Now, when one of our unit holders or some of our unit holders are taking an exit from our scheme, don't you think we should be actually giving them whatever income is due on their investment till the date of redemption? Right, guys? Yes or no? When these investors are taking an exit in the month of May, and in the month of May, have we generated some income? Yes. Income from May is like, what is the income that we have generated? Income for May is 34.425. Amount is 34.425. This is the income which has been generated. Now, this income is entitled by how many unit holders, guys? How many unit holders?
306.
306. Perfect. So in the month of May, whatever income is generated, that is entitled by this 306 unit holders. Okay. So per unit will be 34.425 divided by 306. So per unit, we have our total income, which is being totally generated till now as on a per unit basis. Sorry, per unit basis won't be same. It will be this divided by this. Yeah, 0.1125. Okay. Yes, Pooja.
So, while calculating this May price, we have taken opening value to be 18 point, that the same price we have
Correct.
taken.
Correct.
Why we are not taking that April month end value to be opening?
Because April month end value NAV is not given to us because we don't have information about the price appreciation that has happened. Portfolio value appreciation is not given, but whatever is the income that has been generated in the month of April and May, that will be added in the form of dividend equalization here. Got it?
Okay, sir.
Yeah,
I was taking that issue price 19.201.
No. Because their entry load is there. So how can you take that thing? Right? So entry load is there. So you can't consider that. We take the opening NAV and then we adjust for the income that has been generated during those 2 months. So in the 2 months on a per unit basis, we have generated an income of in the month of May itself, we have generated an income of 11.25, 0.1125 on a per unit basis. So total income that we have kept for ourselves is, one second, let's remove this. Yeah, so exit load is already subtracted. Now, how much is the total income that we are going to give out to our unit holders? Total income by May end. So on this 306 units, total income that we have is 22.95 for the April month, 0.459 that we have collected on this 6, and plus 34.425 that we have generated on 306 units. And on a per unit basis, we can say we have 0.189, 0.1890 as the per unit income, which is available for distribution. Got it, guys? Because in the month of April, per unit wise, we have generated like 0.0765, which we have duly collected from the new unit holders. And in the month of May again, we generated like 0.1125. So totaling up to 0.1890. Or you can also say dividend equalization will be simply 0.0765 for the month of April, plus for the month of May, it is 0.1125. Okay. So this is 0.0765 plus 0.1125, which is 0.1890. So this is the dividend equalization that we are collecting. We are going to collect from the, we are going to pay out to the persons who are taking an exit from us. And therefore, we will get the final repurchase price. So repurchase price will be just the addition of these two, 18.5640. Okay. And of course, from this, we are going to reduce dividend equalization paid to 3 lakh units. So we are going to pay out 3 lakh units. On those 3 lakh units, the per unit amount is of course 0.1890, and amount wise, we will be like this multiplied by 3. So your dividend accumulated income gets reduced by 0.567 because that is what you're going to pay out. Okay. So now we will say income available after redemption. So after redemption, how many unit holders are left now? Out of 306, 3 lakh unit holders were redeemed. How many unit holders are left now? What is the balance?
303.
303 unit holders are left, right? On which we have a total accumulated income available for distribution is 57.265, and on a per unit basis, it is 0.189. On a per unit basis, it is 0.1890. Got it, everyone?
Yes.
Yeah. So that's the redemption price. So we did the second and the third part. And of course, the income available for distribution is being computed simultaneously. Now, we are not stopping in the month of, in the month of May. Rather, we are going it continue for the month of June also. So we'll have to add income of June. So income of June will be on a full 303 lakh units. All the remaining 303 lakh unit holders are entitled for it. Amount income is 45.450. 45.450. So on a per unit basis, you can say it is 0.15. Then we'll say total income available for distribution. So on those 303 lakh units, total income that is available is 0.3390. Total income which is available for distribution is 0.3390 on a per unit basis, and of course the total amount accumulated is 102. Now, have the unit holder any redemption, anything happening? No. What they're doing at the end of June, 70% of its available income was distributed. So whatever is available out of that 70% is distributed. So we'll say less dividend paid. So on 303 lakh units, we're going to pay a dividend of 70% of the income. Total, whatever is the accumulated amount, 70% of that is distributed, and then per unit is amount divided by number of units, which is 0.2370. 0.2373, sorry, on a per unit basis. And then whatever is left out, we can just write it over here. Balance left. So on this 303 units, we still have like 30.8151, and on a per unit basis, it is 10 paise, 0.1017. This is the amount which is left over to be distributed at a later stage. So dividend is paid as 70% of 70% of income. Okay, so balance left is 30.8151, which is yet to be distributed, which will be done obviously at a later stage. Okay, so we have got the income available to distribution, repurchase, and everything is done. Now we have to look for a cash balance which we have. We need to look at the cash balance which we are having, or total income which is redeemed, the distributions that are done. So I need to account for all of that together. So I need to get, as compared to the opening value, what is the increase in cash balance at the end. So let us compute change in cash balance from, so we want like change in cash balance from April to June. Opening cash balance opening cash balance. Well, we don't know because we don't have it in. Rather, we need to just look at what is happening with the cash balance, the changes in cash balance that are happening. So first is the changes that we talk of is income received. So income received in the month of April, May, and June. So income that we are receiving is 22.950, then 34.425, then we have 45.450. So this is the income which is a inflow for us. Then we will add to it units issued. The units have been issued. So units that have been issued is like, it is simply 6 multiplied by, what is the issue price? Issue price is 19.2015. Okay, so that is 6 multiplied by 19.2015. Add units which has been issued, 115.209, which is 19.2015 into 6. That's the units that we are redeeming. Then there have been, units have been issued, so we'll add. Then we will subtract the units redeemed. Now the units that will be redeemed is 3 multiplied by, the redemption price is 18.5640. Redemption price is 18.5640, which will be 3 multiplied by 18.5640. So this will be a subtraction, right? Then again, we are going to reduce dividend paid. So dividend paid will be 70% of income, which is 71.9019. This is what the dividend has been paid. So dividend paid is 19.9019. So is there anything else that has happened? Any new investment made? Have the question specified anything? Any new investment made, or any new shares or securities purchased or sold? Nothing like that. So we can say this is going to be the net change in cash balance. So net change in cash balance will be summation of all of them. So we can say our cash balance is going to increase by 90.4401. Is the value by which the cash balance is going to increase. Correct? Then we will compute the NAV. So it's like calculation of NAV as on 30th June 2000 or whatever it is. 30th June, only 30th June. So we take like opening value of assets of the mutual fund, or opening value of net assets of mutual fund. So opening value of net asset value of mutual fund is like, net asset value is 18.75. This is 18.75 multiplied by, we had 300 units. So this is the total opening value. We will add to it portfolio appreciation. Portfolio appreciation will be 425.47. $425.47. That's the portfolio appreciation. Okay. The other things that have happened, cash changes, net change in cash is already accounted for. So net change in cash is already accounted for as 90.44 net change that has happened in the cash, right? Then rest all income received, payment, and all other things are already accounted for. So I can simply take the sum of all of them at 6140. This is the closing value of net assets of the mutual fund, which is 6140. Then we will say closing units. The closing units will be like 300 plus 6 units which were allotted minus 3 lakh units which were redeemed, right? So this is simply 303, and then we get the closing NAV. Closing NAV as on 30th June. The closing NAV as on 30th June is 6140 divided by 303, which is 20.27. That's the amount of closing NAV. Okay. Are we good, guys?
Yes.
Okay, so any queries in this question? Quite an interesting question, and also you were tested for the CA inter concept also in regards to accrued interest. Are we clear with these questions? No doubts? Absolutely clear, guys. No queries? Okay. So if that is done, yeah, it's a bit complex, but yes, once you get an idea of what we are really talking about, it's just the simple way to deal with this question. Okay, now last part of this chapter, which is actually something what we have already covered, in the portfolio management topic. How do we really know, whether a mutual fund is performing good or not? How do we really measure whether a mutual fund has provided or mutual fund has performed better for its investor as compared to the others or not? I actually learned those tricks, learned those tools in the CA inter, not CA inter, my bad, in the previous topic, which is the portfolio management. So mutual fund performance measures. There are many different measures, but right now, for our simple understanding, we are going to take 3 simple measures, which we have already covered. One is called as the Sharpe ratio. Okay, so this is something what we call as Sharpe ratio. How do we get the Sharpe ratio? Do we remember Sharpe ratio? Yes.
Return on security less risk-free rate of return divided by standard deviation.
Correct. So Sharpe ratio is return on the portfolio minus risk-free, right, divided by standard deviation. Then what about trainer ratio? Trainer ratio was return on portfolio minus risk-free
On the basis of beta.
So this gives you like risk premium per unit of standard deviation. Trainer ratio gives you the risk premium for each unit of beta or the systematic risk. Then we have also learned something called as Jensen's alpha. Right, guys? Jensen's alpha. So Jensen's alpha is also computed as what? Return of portfolio minus CAPM return, or to simply call it as, it is calculated as return of portfolio minus risk-free plus beta into RM minus RF. The same tool we are applying even for Jensen's alpha over here. So Jensen's alpha is return of portfolio minus the CAPM return. Right? So Jensen's alpha is return of portfolio minus the CAPM return. Okay. Now, these three measures are something which you have already covered, and the same criteria, higher the better. Higher these numbers are, better is the performance of the mutual fund. One additional performance measure which we just have to have a primary look or a preliminary look, not to deal much about it, is something called as Sortino ratio. Now, Sortino ratio is similar to Sharpe ratio, but the only part is we don't divide it by standard deviation, but we divide it by downside risk of the portfolio. Like how Sortino ratio is a bit, is a theoretically better term as compared to Sharpe is. When we compute standard deviation, we take the deviation of all the numbers from its mean, which may be even upside or which may be even downside. But just think from an investor's point of view. Are you really worried about the upside movement of your shares, the upside deviation of the shares? Are you really worried about that? No. Correct. For example, if I ask you returns, if I tell you that there are returns, let's say if one time it gave you 10%, another time it gave you, maybe 12%, then next time it gave you like 8%, then it is 3%, then it is 21%, then it is, let's say again 8%, and it's 18%, right? So if I take an average, simply take an average of this comes out to be 11%. So whenever the deviation is like, from this, so return minus 11%, so 1% negative. Similarly, I compute the deviation for all other numbers. Are you really considering each of these deviation number to be a risk for you? Do you consider each of these deviations to be a risk for you? No. Sir, this 1%, I can obviously perceive that negative 1% is a risk, but positive 1% is not a risk for me. So for me, risk is always when it is negative in nature. I mean, the deviation, whenever the deviation is negative, only that is something which I can perceive as a risk. Whereas all the positive values are deviations which are not at all of worry for me. So when I calculate the Sharpe ratio, I take this square of all of them. I take the square of all the deviations. Right? I take the square of all the deviations. But in Sortino ratio, we don't consider the positive deviations. Right? So what we compute is Sortino deviation. Sortino deviation is only the negative value. And whenever you have like a positive deviation, you say there is no risk in it. Got it? So whenever there is a positive deviation, you say there is no risk in it. Of course, if we have a negative deviation, we count that as a risk, but not in case of others. So now we have like Sortino deviation of numbers which are negative in nature, because whenever there is a positive deviations, that is not the risk, and therefore when we are computing the Sortino ratio, I won't be considering this deviation in my calculation. I will be considering only this deviation. So you will take a square of it, right? And then you, instead of standard deviation of all the deviation numbers, you will take only the downside risk, and that is what is calculated under Sortino ratio, a theoretically better term as compared to Sharpe ratio. Now again, here the decision rule is same. Higher it is, better it is. So better return over the downside risk. Okay. So with that, we are through this topic of mutual funds. If you have any queries, we can definitely discuss that right now.
Students, if you have any queries, you are free to ask.
No queries. Okay. Thank you, Sanya.
Okay. Okay, student, with this we come to the end of the topic of the mutual fund. Now, student, regarding this topic, there is one doubt among the minds of the student that sometime if you see the provisions of the taxation applied in the study material of the AFM may be quite different from the actual provisions because of taxation rules. Please note that, student. Basically, it is a AFM is we can say that of course it's independent of the taxation paper, or we can say it is a kind of a global paper. So every country has their own taxation rule. So we in every question we cannot blindly assume that student may be aware about the taxation provision of Indian Income Tax Act. Accordingly, please follow the instructions that has been given in the question regarding the income tax provisions or income tax given like rates, etc. Because it may be possible that the corporate may be taxed at a different rate that has been provided in the study material. So in this regard, please follow the instruction that has been given in the question. So there will be no, it will not be incorrect because you say, sir, no, income as per Income Tax Act, this is not there. So please follow that instruction religiously. Now, so far as the next topic, that is derivative, is concerned, student, there is a Diwali break, okay, on 1st November. So we shall now meet on the Monday, okay. Then we will start with the topic of derivatives. So please revise whatever we have discussed in this class, in the previous class as well as this class. As usual, Jagbandu sir, just share my email ID as well as telephone number. Okay, Abrikesh ji, if there is a confusion, of course, today we will resolve the same. Okay.
Okay.
Okay, Abrikesh sir, what is the confusion? You can share here now, no problem.
Actually, in schedule after 30th October, matlab today evening session, direct date was 11th November, and that also some other topics. I mean, it's not for our topic, matlab either of the three, any subject.
Okay, no.
So next class will be for which November?
It will be on the 4th November.
Okay.
Okay, Monday.
Okay, because Kulkarni sir was has told that his next session will be on 2nd November.
It is sir FR. Basically, I am talking about
Yes, yes. No, I am talking about total, in totality, sir. I mean, not only our subject.
We will get it updated. Don't worry.
Okay. Thank you, sir.
Okay. Okay, students. So you can call me at this contact number, or you can send me an email. SFM is small in a small font. Okay, in a smaller and if even you can send it through the mobile. So, student, I wish you the very happy Diwali for the because Diwali is day after tomorrow, and there are 2 days of Diwali are meant for the same. So, my best wishes of the Diwali to you. Celebrate the Diwali, and we will meet you on the coming Monday. Okay, Jagbandhu sir, happy Diwali. Wish to same to you also.
Happy Diwali to you also, sir.
My pleasure. And
Diwali, sir.
happy Diwali. Thank you, beta.
Happy
Thank
Diwali, sir.
Same to you, beta. And happy Diwali to all technical team. And of course, sir, Jagbandu sir, thank you very much for sparing your precious time and enlightening the student on this topic. Okay, student. Then see you in the next class. Thank you. Have a nice day and happy Diwali
Thank
once.
you. Thank you, Ashok ji. Thank you, Jagdubandi sir.
Okay. Thank you. Thank you.